So now I'm going to jump into the partnership ones. And again, I think we just want to understand the flow. And if you compare it to the previous flow, right, this is one tax return right here on the Schedule C. So the Schedule C is all in the same individual tax return, one tax return. Not the case with partnerships and S Corps. And I think this is really important for you guys when clients ask for a K1 or they ask for the partnership or they're saying I'm waiting on a K1. Understand this is basic stuff, but it's super important to memorize, is that the partnership or S corporation return is going to be its own return, and the 1065 or 8825, it's a rental. It's still on a 1065. Is going to spit out a K1 for each partner. So as many partners there are, there will be an equal amount of K1s, and then those K1s get filed onto the Schedule E. They go on Schedule 1 again, then it shows up on line 1040. So this should look familiar. Again, the big point here is that there's an entire return to deal with before we even get there. And you might say, well, wait a minute. Couldn't we just do a Schedule C and wouldn't that simplify it? There are nuances there, but I think it is very true to say that if you have the same business, you would have a more simple tax return. And sometimes people don't need complexity. Some people feel like they do. Oftentimes you do not. So let me just pause there. Mike, do you have anything to add up to this point on partnerships and individual returns?
No, I don't think so. I mean, basically, just when you look at that form, you'll be able to see. And then if you look at it too, I think maybe, is that your next slide, Miguel?
Yeah. Which one?
I was just going to say you could see too, you'll see the name, but then you'll also see in that column B, you'll see if it's an S Corp or a partnership based off of what's, well, I have it circled there in red. So I guess I jumped ahead.
No, that's perfect. So going back to this, and again, like when would you need this, right? I think sometimes people are just looking at their individual return, Sean, when you're kind of trying to price this out. You could easily, if they say, I don't know if it's a S Corp or partnership. This is kind of a neat trick, right? Can you go to your Schedule E page 2? You say yes. As Mike said, hey, what's in column B? What do you see there, right? P would be a partnership, obviously. S would be an S corporation, and you'll have kind of other information. But this information, this 37, is what flows through back to the Schedule 1. So again, this is going to look familiar, right? The C goes on line 3. The S and the partnership, as well as rentals on Schedule E, will all go on line 5. So again, if you want to see what's all rolled up into line 5, you go to what form, Sean Farrell? I'm just kidding. I'll tell you, Sean. I will test you later, though. You go to the Schedule E. So this would have, if
I think it's Schedule E.
That's half right, Sean. It's Schedule E page 2.
Oh, I was going to follow up with that, but you interrupted, so I didn't get the opportunity.
Very
Schedule
good, Sean.
Yeah.
Always,
yeah.
Always on top of it. I appreciate it. So
Yep.
when I ask you about this 10 days from now, you're going to nail it. I love it.
Schedule E page 2.
Yep. 10 days from now, I'm setting a reminder on my phone. Do not.
You do it. Set that reminder. Don't forget.
Yeah, absolutely. But no, seriously, Sean, I mean, I think Sean, or kind of, if we're picking up a new client for the first time and you're a tax advisor and you go to this and you see multiple entities here and, we look back and we say, in Asana, it shows up as a simple tax return. And Leah, that's something that we're going to have to kind of figure out is the nomenclature in Asana should say, hey, this is a basic return. And if you see basic and you see like 5K1s, we gotta price that out. So scoping is super important. There's kind of things we need to check. It's going to take more time. And usually, somebody with a lot of K1s is used to, complexity is not going to be hung up on, you know, getting the scope right. So back to that, the Schedule 1 shows up on line 5. Schedule C shows up on what line, Sean Farrell? I'm kidding. It's right here, Schedule 3. Don't even say it. So the schedule, so again, it's the same one. So let's see. Oh no, I got this in here a few times. Well, this slide is in here 3 times to really make that point. And then sometimes you will see line 5, line 3 populated. And that's when they've got multiple businesses that we need to kind of look at. Also important from an information request standpoint. I know, Dylan, we rely on the client intake. But again, if you have an intake that doesn't say they're waiting for any K1s, but you go to Schedule E, page 2, and you see something there, that's kind of a moment for pause to confirm with the client. So very good. So I think with that, I had kind of some other issue spotting items that I spoke with Mike about. I wanted him to kind of touch on that. The only one I added, Mike, to our list was, if we do have the partnership return and you see that there are multiple partners in a fund, for example, we do need to confirm every year, and you can do this with QuickBooks, but I like to confirm with clients every year that the capital contributions have not changed. It is sometimes the case that they do, and ownership percentages will change kind of throughout the year. Partners will get bought out. It's a good confirmation question to ask. Again, Sean, I think it's something to kind of put in your wheelhouse. How many partners do you have? What are the ownership splits? And have the capital contributions or profit and loss allocations changed from the prior year? That's going to be a really good question, and it's going to get them talking about their business and what they have going, right? So with that, yeah, Mike, you had some really good bits on what you look at, and just kind of top level partnership S corps. We've kind of brought them in together as the same things. There are some distinctions, so feel free to make those distinctions, and if we're oversimplifying by combining, please call that out. So with that, I'll hand it over to you, sir.
Yeah, sure. So basically, usually the first time that I look at a S corp or a partnership tax return, just kind of try to get a flavor for it by looking at 3 different things. Usually want to look at their financials, so either QuickBooks or Wave or whatever they have, and just kind of see the bank accounts, if they're reconciled and all of that. So usually if you see somebody where in QuickBooks, it'll show you what the balance is per the bank. So if it's Chase, it'll say Chase says that the account has $5,000 in it, and then it will show you QuickBooks, and QuickBooks might show that it has $100,000 or negative $100,000 in the account. So usually when you see big discrepancies there of more than a couple $100, you know that they don't do the best job of keeping their own books, and that's almost something where they probably need some help from us, just because they're not cutting it by themselves. So that's usually item 1 I look at. And then the second items there are checking the profit against the M1 and the income statement. So basically what that is just making sure that the tax return. So over here on line 1, it says that for the prior year, their book showed a profit of $247,000. And then just a nice quick check of it, just to kind of do a diagnostic, is to look at the QuickBooks file and see that that number is exactly the same. So ideally it should match up. If it's off by a couple of dollars, not a big deal, but if that says 247 and QuickBooks shows 350, that something's off. A couple of weeks ago, we were talking to a client, and his QuickBooks showed a profit of like $100,000, and his tax return showed a profit of, I think, $1 million. So obviously that's something where we brought it up to the client, and what he said was that they had switched accounting systems halfway through the year. They had support for everything, and they were confident that the number was correct. But obviously, any discrepancy there, you usually know that that there's an issue. And then the third item that I usually look at is the balance sheet. I don't think there's a copy of that in here, but basically the balance sheet just shows all of the assets of the business, and then separately it shows the equity that the owner has in the business and the liabilities of the business. Biggest red flag there is that sometimes if they either do it themselves or the accountant wasn't necessarily the greatest, you'll see a balance sheet that doesn't balance. So it might show that they had, $100,000 in assets, but no liabilities. And in that situation, you usually know that there's some review that we need to do with the prior year tax return. And obviously, if it doesn't match up between the balance sheet on the tax return and the balance sheet in QuickBooks, it's just, same thing. We know that there's a problem. So yeah, so basically, if you look at line number 14 on this statement, this is a partnership, but line number 14 and line number 22 should always be the same. So if they're different, there's an issue. The balance sheet, it needs to balance. When it doesn't balance, when those two numbers don't equal out, there's a problem from the prior year. And then last two items there, it looks like basis considerations. Sometimes what you'll see is a person has a large loss on the tax return, maybe a loss of $50,000, but to get that loss, they took out a whole bunch of loans and different things, so it wasn't their own money that contributed to that loss. In that situation, we won't be able to take that loss. Scenario that I could think of recently was a client, they had been withdrawing money. Basically, they were taking out loans every year, SBA loans and different credit card loans, things like that. And they would take that money and distribute it to themselves personally. But what was happening was they didn't have basis in the business. So this is kind of an unusual one, the basis issues. But they didn't have basis in the business, and they were doing something with the prior accountant was doing something with a loan account, and it just, it was a major issue. And then they brought in their own outside business consultant, and the business consultant brought it up as an issue. We brought it up as an issue. So kind of, basis can get tricky. There's a lot to it, but definitely, we always want to make sure that they're in compliance with the basis. And when we're looking at that tax return for the first time, it's usually a good idea right by the K1, either a few pages after that or at the back of the package, you should see a basis worksheet. And, that's something we're always going to want to try to track down, just because that's important, especially now the IRS has started asking for us to provide that on the personal tax return. It used to be something where it was just kind of an internal document, but now when there's a loss, the IRS wants to see that information on the personal tax return. So, it's definitely something that we either have to try to back into if they can't give it to us, or might have to ask them if they could dig through their paperwork and try to find a basis worksheet. That's always important. And then probably this last one too is a big issue with the S corporation. It's different than a partnership in that they have two different buckets. They have their income, which is only subject to ordinary income tax, and then they have so that's the K1 income is only subject to ordinary income tax, and then they have their W-2, which is subject to ordinary income tax plus Social Security and Medicare taxes. And sometimes you'll see an S corporation where I believe it's line 7 is the owner's compensation. If that's a 0 or if that's a real low number and the profit is high, that's an issue, because that's something that the IRS, they look at that very closely, and they want to make sure that the owner is taking a reasonable salary, just because you look at it as if you have no W-2 income and $100,000 in K-1 income, you avoided Social Security tax on $100,000. So the IRS, that's something that they scrutinize fairly closely, and that's only an issue for S corps. Partnerships, we don't have to worry about that.
Very, very good point. And I think just in practice, what that means is, at the kind of intake side, Sean and Dylan, These are kind of things we can confirm, and there doesn't necessarily need to be an action item, right? But even just a simple question of, oh, you're an S corp, okay, how much did you compensate yourself? And you'll hear a lot of people who start S corps or have just been kind of running it themselves because they read on a blog somewhere that you can save self-employment tax, will say, I haven't paid myself anything. And that's a point where you can say, that's interesting. Why is that? And are you aware that's something that the IRS looks at? We don't want to scare anybody, but you definitely want to say, okay, that's something we can definitely help you with and we'll advise. And certainly at the intake level, for our client help team, you get an S corp, you got to ask for you got to make sure we got the W-2s for the full business. That's just something I like to ask for, to make sure we have all of them or access to their payroll, so that we can kind of match up not just the owner comp, but the total comp. So we might want to add that to our intake process as just something we ask for. And then kind of at the tax advisor level, we have to kind of think through ways as we offboard, if you will, that we basically say, hey, we did your tax return this year because the numbers are what they are. But going forward, you're going to want to see this number change because it's going to be something that may come back to us as your tax firm of record. So I know the client you're referring to, Mike, and I do think that I think we've adjusted it for it, but we might need to do kind of a mid-year check-in on that client to see where they're at payroll-wise. And the other benefit, I think, too, is if this is a client that does research and development, increasing owner comp is not just the right thing to do, but it's favorable from a tax credit perspective. That might be a specific fact pattern, but again, my goal is to kind of give you guys the tools to think through, think about where, there may be kind of questions for the reviewer, for Mike or myself, if I'm reviewing. So just with that, Mike, thanks so much for your take. I think Mike certainly looked at way more S corps and partnerships than I have in my day. So the experience shows. Thank you.